I'm CPL Wegado Anthony. I'm the financial accounting teacher. I'll be taking you through financial accounting 1 unit, which has got around 11 topics. Our first topic is introduction to financial accounting. Introduction to financial accounting. So I'll begin by defining what financial accounting is. Then we'll go to the objectives, and the other areas will follow. So financial accounting is defined as a systematic process of one, identification or identifying, number two, measuring, 3, recording, 4, classifying, 5, we have verification or verifying. After we've done verifying, we have what you call interpretation. We can have analysis first, analyzing, and then after analyzing, interpreting, and finally reporting economic information to the different users. Now, what is identification? Identification is the act or the process of recognizing a transaction. In a business setup, we've got different transactions that take place. You can have a sale of goods, you can have an acquisition of assets, we can have payment of expenses, and so on and so forth. I should be looking at them moving forward. So identification is the process of recognizing an event or transaction to have occurred within the business. That's what you call identification. So it is the recognition of transactions. And then after recognition of a transaction to have taken place, it could be an exchange of a good with a customer. So that we'll call it what? We'll call it a sale. So of how much? The worth of the transaction. So for us to know the worth, we must do what you call measuring. So measuring is the attribution of value to a transaction or to the transaction that took place. Attribution of value or determination of the worth of a transaction. After having the money value of the transaction, now that transaction can fit in the books of accounts. We do what we call recording. So recording is the documentation of transactions in the books of accounts. Then next we have what we call classification or classifying. Classification is the categorization of transaction in different subclasses. We could classify transaction as sales, as purchases. We could classify some elements as being assets, as being expenses, as being liabilities. So classification is the categorization of transactions. And then verification. To verify something, you must have different records that carry similar information, and the different documents must be in tandem one with the other. There must be an agreement. So verification is the act of cross-checking documents. Is the cross-checking documents that are related. So cross-checking related documents to a given transaction. Analysis or analyzing, to analyze information or transaction is to do what we call in-depth scrutiny. It's to scrutinize the information, in-depth scrutiny of transactions, in-depth scrutiny of transactions. When you do a detailed scrutiny, you are doing what you call analyzing or analysis. Then interpretation is the process of giving meaning to information, giving meaning to information for ease of understanding by mainly the laymen who don't understand more, or even those people who are not involved in the preparation of the financial information. So you have to interpret it for them to be able to understand, and of course based on them in making various decisions. Lastly is reporting. Reporting is the process of publishing information, making it public. So reporting is the act of publishing or making public information you prepared, and it takes the form of financial statements. So these are what are used to define accounting. So you're saying it is a systematic process, that is, it is procedural. Everything happens in a given order. All the transactions that are taking place, we do them in an organized manner for us, for the information to be of use to different users. We talked about something called economic information. Economic information is any information that has got what? Economic benefit. That is, it can be based upon by different people to make various decisions that have got economic value, or that will result into economic value to them in the future. Secondly, I want us to look at objectives of accounting. What are the objectives of accounting? We have got various objectives. Some are primary, some are secondary, but I just do them together. Why do we need an accountant, or why do we need to have the accounting function or accounting area within the business? Why is it important? Can't we do without the financial accounting department or the accounting department? Doing without this department or doing without this function might really bring about disorderliness within the business. Therefore, it's important to have an accounting function within the business or within the enterprise. So I'll look at various objectives, why different entities or different companies would have the accounting department, or will appreciate the accounting department within the business. The first one, we are saying accounting helps us in ensuring there's what? Recording of information. So the accounting department helps us in recording transactions that are taking place on a daily basis. So if you don't have an accountant or the accounting function, transactions will go unrecorded. And when we reach a point we want to know how we are doing as a business, it will be hard because we have no records to use as a basis of that. Number two objective of accounting is decision making. You're saying the information we had recorded in our books will help us in making various decisions. Let me talk about sales that we've been making. If we have record of sales, we'll be able to know how much sales we've been able to generate. In case we want to generate more sales, we will base upon the past sales trends, and we will know what to do if we want to earn more sales. Let's say maybe we may decide we need to have a marketing department because our trend in sales is very low. We want to improve it, and therefore accounting is very important because the recorded information can be used in making various decisions within the firm. Then also for planning purposes, though they are more or less the same as decision making. We are saying when we have a financial department or a financial accounting department, it can aid the firm in by providing information that can be used in making short-term and long-term plans within the company. Number four, I will talk about performance measurement. We have a statement called income statement. Income statement, or the profit and loss statement, is used to determine the profit or loss made within the given accounting period. That's how we gauge our performance. So unless you have an accounting department or an accounting function, we cannot be able to gauge our performance and know if you are doing well or not. So accounting is very important in gauging our performance. Next, understanding our financial position. This is done through preparation of what we call statement of financial position. This is what we used to call balance sheet. It contains three main elements: assets, capital, and liabilities. These ones are used to gauge the financial position of a firm at a given point in time. So it's very, very important to have an accounting function, because that's one of the benefits. Next, control frauds. Control frauds. Accounting involves setting up a system of internal controls. We can have controls on cash management, we can have control on investments, among many others. So those controls ensure the firm's resources are used or are safeguarded from misuse. Therefore, accounting function is very important because it will help us to put in place controls that are meant to safeguard the resources of the company. And then we can talk over one more. You have what you call legal compliance. You have legal compliance. It's a requirement that any business that is running to prepare books of accounts upon which we shall determine the tax payable at the end of the year. So it's important to have financial accounting department because it will help us to ensure we are complying with the regulations like determination of tax liability of the firm. And then also when you want to source financial resources from the financial institutions or like from banks, SACCOs, they require financial records. So unless you have a financial department within the company, we will not have anything to provide. Therefore, we'll be unable to, and that will make us lose out or be denied access to finance by the providers of financial resources. So among many other, these are the some of the objectives you need to understand as you undertake your accounting course. Now I want to go to some of the definitions or some of the terminologies that are very important for an accounting student to understand. Unless you understand them, you'll find the accounting journey very rough for you. So I'll go through each one of them, I'll define them and expand them so that you have a good foundation of what lies ahead of you. The first definition is what we call a business. A business is any form of trade. Talking of trade, I'm talking of where we have exchange of goods or services for a fee. It's called a business. So a business is any form of trade where we have got exchange of goods or services at what? At a price. Now you'll find some other terminologies that are used to imply a business, and you need to be familiar with them. Number one, what you call a firm, F-I-R-M, firm. Number two, you have entity. Number three, you have enterprise. Four, you have got company. Five, organization. All these are different from are names that imply a business. So you need to be familiar. You hear somebody talking of a firm, entity, enterprise, company, organization. They all mean what? They all mean business. So get to know that. Then we have got different types of, we have firms that sell goods. We've got firms that offer services. Now, those that sell goods have what we call inventory. And that is our next definition, inventory. And what is inventory? Inventory refers to the commodity that the firm trades in, that the firm trades in. The commodity that the firm trades in, or what you call the trading stock of an enterprise, is called inventory. For companies offering services, they do not have inventory, they only have services, so you never have anything called inventory. So some people call it stock or trading stock. That is the that's what implies what? Inventory. So Inventory is basically the commodity that the company trades in. And then next next terminology I want us to understand is what we call a customer. A customer. Who is a customer? A customer could be a legal person or a natural person. Legal persons are businesses or companies, whereas natural persons are human beings. So a customer is a consumer of the trading stock of the business. It could be an individual or another firm. So a customer is an individual, or I can say refers to individuals or other firms that consume the trading stock of this business of ours, called a customer. Now you've got customers who sell goods, or who buy goods on cash. You've got customers who buy goods on credit. Now those who buy goods on credit are called debtors. They are called debtors. So anybody who buys goods from us in our business to pay for them later is called a debtor. Now the amount the person will owe us, the amount the person owes us for the value of the goods sold to him or her is called accounts receivables. So accounts receivables refers to the amount that a debtor or debtors owe us, called accounts receivable. So don't confuse that. It's often used interchangeably, but know that the accounts receivables is the amount or the worth of the goods sold to the debtor. Next is what we call a supplier. Supplier. Who is a supplier? A supplier could be a business or another person, that's a natural person who provides our business with the trading stock. It's called a supplier. So we have got those who strictly supply to us on cash. We've got those who would allow us to take credit from them. Those who allow us to buy goods on credit are called creditors. They are called creditors. So who are creditors? These are what? These are credit suppliers. And as we saw, debtors are what? Credit customers. So debtors are credit customers. Creditors are what? Credit suppliers. So the word credit doesn't imply creditors. Credit is the act of buying or selling goods for cash to be paid at a later date. It's for the cash flow to take place at a later point in time. That's the meaning of credit. So when you see the word credit, don't imagine that's what a creditor. No, credit is that transaction that takes place at present, but the cash flow in or out takes place at a later point in time. That's what we call credit. So the amount that we owe credit suppliers is called accounts payable. That is, accounts we are supposed to pay, accounts we are supposed to settle. The other one was what? Accounts receivables. Accounts we are supposed to receive money on. That's the debtors. But the accounts we are supposed to pay money on, accounts payable. That's what? What we owe creditors. So the amount is called accounts payable. The person we owe is called creditor. The next term I want us to understand is what we call an event. An event. An event. An event is any occurrence in business that results to flow of cash in or out at present or at a future point in time. It's called an event. Another name used to refers to an event is called a transaction. Transaction. Any occurrence in a business that results to flow of cash today or at a future point in time is called an event or a transaction. Now let's look at the next definition, what we call an asset. the largest of them all, asset. What is an asset? For us to know what qualifies to be called an asset, there are some attributes it should have. We are saying an asset is an economic resource, owned or controlled by a business or a firm as a result of a past transaction, whose future benefits will flow into the firm, and can reliably be measured in monetary terms. Saying an asset is any economic resource owned or controlled by an enterprise as a result of a past transaction whose future benefits will flow into that very firm, and its worth can be measured reliably in monetary terms. From the definition, we get the attributes or features of an asset. What are they? Number one, you're saying for something to be said to be an asset, it must be what? An economic resource. Economic resource means it has economic benefits that will accrue to the entity. Number one. Number two, ownership or control. It must be owned or controlled. Ownership comes from somebody having document of title. When do I have a document of title? Is either I bought the item or I inherited and the document of title is in my name. Like somebody has been given land through inheritance by the parents, and the transfer has been done from the parent to his name or her name. They're saying because the document of title, which the title deed bears their name, they are said to be the owners. But control is where you're using somebody's item, but you don't have document of title. Instead, you have a document that shows you are the one holding it at the moment. Let's talk about a building that has been leased. The person who has leased the building from the owner has what we call a lease agreement. They don't have the title deed or completion certificate from Public Works, so they don't own the item. They are only in control of the item. You hire something, you hire a machine, you hire a vehicle for use for your own business transaction, you are only controlling. You have an agreement between you and the owner. So you don't what? Own it, but you control. And since it is giving you economic value, it's an asset in this case. Number three, we talked about past transaction. Past transaction refers to the event that preceded ownership or control. Before you controlled, what took place? Before you owned, what happened? For ownership, either you had a purchase or you had what? Transfer of title to your name. Those are two events that qualifies you to own an asset. When it comes to control, you can have what? The signing of the agreement between you and the owner of the asset, or the signing of what? The lease agreement. So, or hire purchase agreement for hiring an asset. So, what took place before you own or control what you're calling what? A past transaction. Number four, what we call future benefits. Future benefits are the inflows of economic or the receipts of economic value from the use of the asset, which takes place immediately you own or begin controlling called future benefits. Number 5, what you call money measurement. Money measurement. You're saying for something to be said to be an asset, monetary value should be attributed to it. That is, its value or its worth can be measured with ease. So that's what you're calling what? Money measurement. For anything that has got these features, it qualifies what to be called an asset. Now, we can look at asset classification. Look at asset classification for this level. I'll draw a flow diagram to show the classification. You've got assets. Assets can be categorized into 3 main categories. Number 1, what we call non-current assets. Non-current assets. 2, what we call current assets. 3, financial assets. Financial assets. Non-current assets are those that the firm will benefit from for a period exceeding 12 months or 1 year. Anything you're having in your business and you're going to use it for a period exceeding 1 financial year is called a non-current asset. Then we can break them further into what we call tangible and intangible. Tangible and current assets are those that have physical form, that is, they can be seen, touched, and felt. They have got those 3 attributes: can be seen, like this board I can see, it's white in color. I can press my hand against it, that's I can touch it. I can tell it is smooth. If it has those 3 attributes, then it qualifies to be called a tangible asset. That's non-current asset. Intangible one is one that does not have physical form, can be seen, touched, or felt. Let's look at the further classification of tangible assets. We have what we call depreciable and non-depreciable. This is the file we'll go for financial accounting paper. Depreciable non-current assets are those that lose value over time. Maybe I give examples first, then I can break them further. For tangible ones, I could have examples like land, could have equipment, motor vehicle, could have machinery, fixtures, plant, among many others. Those are examples of tangible non-current assets. Now, among these tangible ones, we have got those that lose value, we've got those that don't lose value over time. So those that lose value are called depreciable. We have got equipment, motor vehicle, machinery, furniture and fittings, plant, among others. Land does not depreciate, it's called non-depreciable. So of all these, land is non-depreciable one. Land is said to depreciate under one exceptional case. That is where we have mineral extraction taking place on it. So any land where you are extracting minerals will lose value over time. But land basically is non-depreciable. Let's look at the intangible and current assets. Intangible and current assets are those that do not have physical form, that cannot be seen, touched, or felt. What are some of the examples? Number 1, we have what we call goodwill. 2, patents. 3, what we call trademarks. And then 4, copyright. 5, software. Among others. These are the common types of intangible non-current assets. You can also have what you call brands. you have investments. So let's define each of the intangible assets from goodwill to investments. Now, what is goodwill? I want to give a scenario to help you understand what goodwill is. Let's talk of a case of a business, like a supermarket. We go and count all these assets, we get the valuations, of course with the help of the valuer. And then we get the worth of the assets is, let's say, 950 million. We go look at the debts or the owings of this business. We find is 200 million. The difference is 750 million. So the owner wants to sell this business and is telling the buyer, I want you to give me 900,000 for my business. But then the buyer is asking, we've just confirmed from the valuer the net assets. So this is what we call total assets. Total assets. And then the total liabilities. Total liabilities, that the owings is 200. The net difference is what? 750. So what you call net assets. After netting off liability, you get what you call net assets. So the buyer is wondering, why am I being charged 900? Yet the net assets, what I'm buying, the physical assets I can see, the evaluation is 750. Now there's something the owner of the business is adding to the 750 that the buyer cannot see. Example is the image of the business, how the public views the business. We've got the strategic location. You've got the customers who come and buy from this business. They will not stop buying because it's under new management. They will still come and buy from the business. So those are some of the things the old owner has worked for. That the public trust this business. They will still come without this new owner laboring for such. So the labor that the old owner has put on this business in the past years is what is adding on the 750 before selling to the new owner. That's what you call what? Goodwill. So how can we define goodwill? Because here we are saying we have our net assets at 750 and we are selling at 900. The 150, what is 150? 150 is the value above 750. What is 750? Net assets. So how do we define goodwill? Goodwill is the value above net assets of a firm. The value above net assets of a firm. Value above net assets of a firm. We go to patents. Next one, patents. Now, what's a patent? A patent, maybe before I go far, let me talk about something called rights. When you have a right to something, when you have a right to receive something, or you have a right to own something, that right creates what we call an asset. Now, a patent is a right given to somebody for what you call technological innovations. Like somebody comes up with I'll give an example of M-Pesa services in Kenya, where somebody had developed a system through which we can do money transfer. When we transfer money always, we have got some charges. We've got what we call electronic fund transfer in most of the banks. You transfer money, you are charged some fees for that. Why are you being charged that money and where is it going to? Part of that money is being paid to the person who developed that system or that technology. So a patent is a right granted by the government to somebody who has come up with any technological innovation. So we could define patents as rights granted for technological innovations. That's why when you're transferring funds, you are charged for that, and many other technological developments. We've seen people coming up with the new types of modern seeds, to improve food production. You've also seen people are doing AI, that's artificial insemination. They come up with different improved types of inseminations for dairy animals. They have to charge you for that. That's why they sell to farmers. So they have been given rights because they have innovated something. They have to earn from it. So they have to get future benefits from it. They own it. It's in their name. They have been given a patent by the government showing the owner of the technology. That's why you've seen even medicines. People who have developed different kinds of medicines. You have got the original medicine, and you've got what we call what? The one that has been epped, which are normally a bit cheaper than the original medicine. So the person who developed the medicine must patent the medicine for him or her to get the proceeds or the returns from the medicine. So the ones that ep the original medicine have to pay something to the original owner, or they have to get permission to reproduce such kind of drugs but sell them at a lower price than the original drug, what we call generic drugs. So the owner has the original. Generic ones have been developed using same formulas from the old developer. So the old developer must benefit from the development or innovation, therefore must get rights from the government to exclude others from using it for their own benefit. And then trademarks. What's a trademark? A trademark, I would basically define it or use a simple example as a symbol of trade. It's a symbol of trade that people use to identify their businesses, called a symbol of trade, like a logo. It's a trademark. So if you develop anything that is used to identify your business, which is unique from other businesses, then you must go to the government and have what you call what? A trademark. Register it. You can even have even art, works of artwork. You must what? Get some something to exclude others from benefit from it. That's why when you develop a logo, you must have it registered under your company name or your business name. So trademarks are just what? Rights granted for what? Rights granted by the government, of course, for symbols of trade. For symbols of trade, e.g. a logo. So that one I exclude. Some businesses colors, like if you see Safaricom, they use color. You look at our revenue authority, KRA, they use red and white as their color, and they have got some logo there, something within it, to signify that is Kenya Revenue Authority, among many other companies. Let's look at copyright. What's a copyright? Copyrights. A copyright is rights that are granted or owned for what? Artwork. For artwork. What is artwork? Talking of artwork, I mean publications. Publications. We have got music. We've got even voiceovers. Even people use their voices and for particular business activities. So a copyright is rights granted for works of art, like music. When you produce your music, you must go to the government and have it registered under your name. By so doing, you're getting what? A copyright. So any artwork rights are called copyrights. Software. What are software? Softwares are computer programs. These are computer programs that are used for automating various functions. Like I will talk about Microsoft Office, one of the softwares. I'll talk of Kaspersky, it's an antivirus to machine. We've got Avast, we have got QuickBooks for accountants, and many others people are developing from day to day. You have some for security purposes, some for running some functions or operations. They are called software. So that's what? They're basically computer programs that run on computer gadgets to help automate different functions. And then brands. Brands, they are more or less the same as trademarks, but brand is just what the corporate image of a business. They could say it's a corporate image of a business. That's a brand. It's a brand. And then you have investments. Investments are volatile assets. Volatile investments are volatile assets. E.g., investment in ordinary shares. When you acquire shares, so shares acquired by the business. Can have debentures acquired. Can have bills and bonds from the government that you've acquired. So when you acquire them, they don't have a physical form, but you have a share certificate, or you're given an account number to signify a certain number of shares that you hold or debentures you hold. We are saying that's also what? An intangible asset. So these are among the many other intangible assets you are going to encounter as an accountant over your journey in your profession. Let's now go to the next type of assets, which we call current assets. What are current assets? Current assets are assets that the firm benefits from for a period not exceeding 12 months. The main type of current asset, is cash. Current assets. The main one is cash. And this cash is used for different purposes. We use it to acquire the trading stock, which we call inventory. We can use it to pay for services. We can use it to pay for, that is for services in the current year and for subsequent year. When we pay for expenses that fall in the next financial year, that cash ought not to have left the business. It is called prepaid expense. So any expense we pay for in the current financial year, but it's for the next financial year, that cash ought not to have left. It's still ours. It's called a prepaid expense. But those paid for this time, they won't result in any other form of asset. So we have got cash used to acquire trading stock, cash to pay expenses for the period. Those ones disappear. But the cash we pay for expenses that are for the next financial year, is that what we call what? Prepaid expense. Now when we sell this inventory, we get back our cash. When we pay for some expenses, we get services. Like when you're paying for salaries, the employee serves you in return. You won't get back the money. You get what? A service to you. They help you generate more revenue in future, which will come in form of cash. So revenue from your clients will also result into inflow of cash. Then when we sell this inventory, we can get back our cash, or we can sell them on credit. When we sell them on credit, it results into what we call what? Accounts receivable or debtors. Accounts receivable. These are the main forms of cash, of current assets. Of course, you can have cash at bank that is being held in the bank account, and cash at hand. Sometimes we may have earned returns on investments. We invested in shares. That's we acquired shares. We acquired debentures. The return on investment in shares is called dividends. The return on investment in debentures is called what? Interest. You've earned the return, that is, you earned interest, or you earned what? You earned dividends. The time you earn dividends, you gain right to receive. But assuming it is the end of the year, the investee company where you had bought the shares or the debentures has announced debenture interest or what you call ordinary share dividends. And the end of the year has come, you have not received. The moment they announce the the interest or the ordinary share dividends, you obtain the right to receive. That right to receive creates what? An asset. I said initially that right to something, when you have a right to something, it creates what you call what? An asset. So you've got a right to receive dividends, a right to receive interest, but we have not received, and you are closing the year. We call that an accrued what? Income. Accrued income. Accrued means outstanding. Outstanding. So income are for receiving, are for receipt. They are for inflow. They flow in the business. So we are saying this is an income which is on the way. We already have a right to receive. We can sue somebody for it because we have a right and is holding it. If it does not give us, we can move forward and sue the person to collect the income from them. So you're saying since we have a right, it's what? A current asset, because the receipt or the inflow should not take a period more than 12 months. It should be so soon. Thus, current asset. That is, we should be enjoying the benefit anytime from now, because the announcement has been made. We have a right to the income. So it's a current asset. So these are the main current assets we'll be dealing with. But as we go on, we have some other few ones we'll be adding on along the way. The last category of assets, what you call financial assets. Financial assets. Financial assets. What are these? What are they? Why the name financial? We are saying financial assets refers to the following. One, the cash we have in our cash till at our business and the cash we have in our bank deposited. So it refers to cash and cash deposit. Then, if you have any cash you've paid for an investment somewhere, another company issued an investment, that is, they were issuing debentures, they were issuing treasury bills, treasury bonds, they were issuing shares, and you paid them cash to give you the, what you call the securities or the instrument, call them financial instruments, and they are yet to give you. We are saying you have a right to receive what? Financial instrument from them. So it refers to cash and cash deposits. Number two, a right to receive financial instruments of other firms. That is, you've paid for shares, you've paid for debentures, but they are yet to be given to you. You have a right to receive that financial instrument from the other firm. Or what? An exchange of a liability in circumstances that are favorable, then we say that's also a financial asset. What do I mean by this last part? Let's say we have a company in Kenya, another one in Uganda. You have your company in Kenya and you borrowed from a bank in Uganda some money, or let's say you borrowed from a bank in the US some money. You have a friend of yours in the US and borrowed money from our country, Kenya. You decide to swap the two. You swap, that is, you give him the debt in US to pay for you, and you take his debt in Kenya to pay for him. You swap the two debts. The two are liabilities to each one of you, but you've exchanged. But you end up paying less than what you ought to have paid. In such a case, you have benefited. The circumstance have favored you. That creates what we call what? A financial asset. But in case the transaction was unfavorable, that is, you ended up paying more than you ought to have paid, then you are saying that's what? A financial liability. We shall look at that one as we go to liabilities. The next definition is what we call financial year. Financial year. What's a financial year? Financial year, in most cases, we abbreviate it as FY. You may see FY 2024, 2025. It means financial year. Now, a financial year refers to the duration within which a firm prepares its financial statements. Usually, it is 12 months on standard, and you have got different durations for different companies because they choose what they feel works well for them. I will list a number of financial year durations here. The first one is 1st January current year. 1st January current year to 31st December current year. Another one you'll expect to encounter is 1st April current year to 31st March following year. Another one is 1st May current year to 30th April following year. We may have another one, 1st July current year to 30th June following year. Another one that is commonly used also is 1st September current year to 31st August following year. You can also have another one, 1st October, not commonly used. You may have 1st October current year. October will come to when? 30th September following year. So these are the common types of financial year durations you're going to encounter in different questions as we'll be doing other topics ahead. So it's good to know about them so that if you see the year ends on 30th September, you must have known where it began. That's 1st October, the previous year, because there are some expenses which have been paid and therefore the next year you must know how to account for them. So this was important in terms of being able to do what you call cutoff. We'll look at that in auditing later. You must know this expense or this payment falls in which year. Very, very much important. Or the income, where is this supposed to be accounted for? Or where is it supposed to be earned? So all that shall be guided by the financial year durations. Let's look at the next definition, what we call liabilities. Liabilities. What are liabilities? So liabilities are financial obligations of a firm. Any obligation that will result to outflow of cash at present or in future is called a liability. Now we have got three classes of liabilities. Number one, what you call non-current or long-term liabilities. Long-term liabilities. Number two, what you call current or short-term liabilities. And lastly, three, what you call financial liabilities. So let me define each one of them as I give examples of each for you to be able to understand. Non-current liabilities or long-term liabilities are those that the firm is required to settle over a long period of time. Examples of long-term liabilities are one, debentures. Number two, long-term loans. So these are debentures issued, not just debentures issued. Long-term loans taken by the firm. The loans taken. You can also advance a loan, where you advance a loan, like what banks do. When banks advance loans to customers, the loans to them are what? Assets. But to the borrower is a liability. So it depends on whether you are the one giving the money or receiving the money. If you are giving the money, that's your money. It's your asset. It's what you own. So long-term loans that have been taken, that's a liability. We've got what you call obligation under leases, obligation under finance lease, That is rental payments that are long-term in nature for a lease you've taken for a longer period of time. So that's the rent that is due in the long run. It's called obligation under finance lease. So that's what you're calling what? The long-term liability. You can also have what you call mortgages. A mortgage taken, so that's a liability, among many others. So we'll be dealing basically with the first two at this level, but moving forward, you see others coming in play, and I will explain more about them as we progress. And then number 2, what you call short-term liabilities or current liabilities. What are they? These are your owings that you are supposed to settle so soon, within 12 months period maximum. They are called current liabilities. The common type of current liabilities is from the goods you've taken from suppliers to pay for them later, called accounts payables. Accounts payables, or what you call trade payables. These are the main type of current, the common type of current liability for any business. Then we have got any expenses that are due by end of the year that have not been settled. That is unsettled expenses at end of the year. They are called accrued expenses. Accrue means outstanding. Accrued expenses are what? Are also liability. It could be accrued salaries, accrued electricity, accrued insurance. So expense you've incurred within the year, but the year is ending, you're preparing our books of accounts, this expense remains outstanding, you incurred it, you've not paid for it, you are liable to pay. That's a liability. And when are you supposed to pay it? So soon, because you delayed. The time for paying has already passed and you have not paid. Then you are saying it's what? It is to be settled so soon. That's a current liability. Then you have short-term loans. Short-term loans. Can also have what? Obligation under short-term leases. Among others. Could also have what you call, I will give an example. When you've issued shares and you have made profits, the end of the year has come, you've promised to pay dividends, what you call proposing. You proposed dividends to shareholders. Once you make a proposal, that proposal creates a liability. So you have what you call proposed dividends. Proposed dividends, we look at them in company accounts. You can also have what you call tax payable. When you make profit for the year and we get the tax liability which is supposed to be paid the following year, we are saying it becomes a payable, tax payable, to be paid in less than 1 year. So we shall look at many others as we move along that we'll be dealing with in other topics. So that's all about current liability. The final type of liability, what you call what? What we call financial liabilities. Financial liabilities is more or less the same as financial assets. I want just to derive it from the financial assets. We talked about financial assets. It's the right opposite of what? Of financial assets. So financial liability, if I would borrow from assets and get the opposite of it, we said financial assets were what? Cash and cash deposits. Okay? So for liability, I would say is cash and cash deposits due to other firms. The one we had was ours and not due to anybody. It was an asset. The one we have that's due to other people or other business, what? A liability. So we could define it as cash and cash deposits due to other businesses. Deposits due to other firms. Cash and cash deposit due to other firm, that's a liability, financial liability. Number 2, we had said for financial asset, when you acquired financial instruments and you have a right to receive, it becomes what? It becomes a financial asset. For liabilities, what? We have issued financial instruments, been given money, but you have not given the securities or what you call financial instruments. So we are saying it is cash and cash deposits due to other firms, comma, an obligation to transfer, or to transfer financial instruments to other firms. Lastly, we said for a financial asset, we can swap liabilities, and then the one we end up paying is less than what you ought to have paid. That becomes what? A financial asset. For the liability, it is the case where you end up paying more than you ought to have paid. That is, the circumstances are unfavorable to you. So you're saying it is cash and cash deposits due to other firms. Number 2, obligation to transfer financial instruments to other firms. Or what? Exchange of liability, exchange of an obligation, exchange of obligation or liability under circumstances that are unfavorable, to the firm. So such are what? Financial liabilities. Okay, having understood that, let's go to something else. What we call revenue. Go to revenue. What is revenue? You got revenue or sales. What are these? Revenue refers to receipts of cash or inflows of cash from services rendered, whereas sales is inflows of cash from goods sold. So revenue results from what? Services rendered, but sales results from sale of trading stock. So when you sell trading stock, we earn what? What we call sales. But the money we get from people who have enjoyed our services, we call it revenue. So there's nothing like sales revenue. It's either sales or revenue, unless you are doing both. You're offering services and you are selling goods. You can call it sales stroke revenue. But it's either revenue from services or sales from sale of trading stock. Now number 2, you have what you call cost of sales. Cost of sales. We talked about sales, now cost of sales. What are these? Cost of sales. There are 2 words here. The cost then of sales. So the 2 is cost and sales. So this is a cost that relates to what? Sales that have been made. What does it imply? Cost of what has been sold is the price we incurred in acquiring the trading stock. Now, the trading stock we sell in the current year, part of it was acquired last year. Part of it has been acquired this year. So that is what has been sold. Part of it remains unsold. So what is cost of sales? Cost of sales is the price at which the goods that have been sold were acquired at. It's called what? Cost of sales. So what does it contain? Or what are the elements? We are saying what you sold, part of it was bought last year. It's called opening inventory. Part of it has been bought this year, which you call purchases. So this opening inventory is basically all the purchases. The timing is what makes the names different. But this is what? The opening stock is last year's purchases. We call them old purchases, just last year's purchases. Purchases here now in this context refers to what? New purchases. That is, goods that have been bought in the current year are called purchases. Now you have got those that have been bought within the year but have not been sold. We call them closing inventory. Closing inventory is what? Unsold purchases. That's the best way to understand them. Unsold purchases. So you want to get the cost of what has been sold. We are saying we had this and this available for sale. We call them cost of goods available for sale. But have we sold everything? We are saying no. We have got part of it that we bought this year that remains in our stock. Because we don't have we are saying the ones we've sold have a sales value. This one still in our stores, we don't have a sales value because no one has taken them. We cannot attribute a sales value to them. So they are still unsold. The value of unsold is the sum of this and this less this, because this one is part of this. So what we have is what we call cost of sales. The price at which goods that have been sold were acquired at. It's called cost of sales. We go to the next one, purchases now. What is purchases? Purchases is the price of the trading stock acquired in the current year. The price of the trading stock acquired in the current year is called purchases. The price of trading stock acquired in the current year is called purchases. After purchases, we go to what we call incomes. What are incomes? What are incomes? So incomes can be defined as follows. It's saying they are what? They are basically returns on investments. How can a firm invest, or how can one invest? You can invest in a business. You can invest by acquiring acquiring shares. You can acquire, so acquiring debentures. You can advance a loan. You can build or construct real estate property. Can acquire or build a real estate property, among others. So these are the main investments that a business can engage in or one can have. So returns on these investments are what you call what? Incomes. In a business, the return is profit. That's the income. In shares, the return is dividends. Dividends received. In profit, this one, profit and dividends. Can say even dividends and not just received. And we have what you call debentures. We have got interest on it. Interest on debentures. Of course, the and one. Also interest and on loans you have advanced to other businesses. If you build real estate property, you earn what you call rental income. So you have rent and rental income. Rental income is what you earn from other people using your real estate properties or rental income. These are the main incomes we are going to deal with. Beside this one, we also have what we call what? Reduction in provision. So other types of incomes, I will list them as one. Reduction in provisions. Reduction in provisions. E.g., reduction in provision for bad debts. E.g., reduction in provision for bad debts. We shall look at it in topic number 4. We have got commission received. If you receive any commissions, like for insurance companies, They usually receive commissions when they do what we call reinsurance. When they transfer insurance business to other firms, they earn what we call commission. To them is an income. We have what you call when you buy goods and the price is reduced, you are given what you call what? Discount. So discount received is also another form of income. Number 4, unique type of income, what we call disposal gain. Disposal gain. When you dispose an asset and you end up disposing it at a gain, we are saying that is another form of income. So we shall be looking at this and dealing with them. Please work on them, start to master them over time, but we shall practically look at them in other topics. Next one is what we call expenses. Expenses. What are expenses? Expenses are costs incurred in revenue generation. Costs incurred in generating sales or revenue. They are called expenses. These expenses can be split into two. You've got cash expenses and non-cash expenses. It's good to know this. As early as now, you've got cash expenses, you've got non-cash expenses. Cash expenses are those that result into actual cash outflow. That is, we can locate cash out paid because of that expense. And where can we locate it? Either on our bank statement for expenses paid using checks, or we can also locate it on what? On our cash book. So any expense that we shall pay for, and that is we can prove a cash movement out of the business, is called a cash expense. Our list examples could have salaries and wages, could have insurance, could have office expenses, have motor vehicle running costs, or just like something like fuel, among others. We shall look at electricity. We can always locate the outflow on the cash book or the bank statement. Non-cash expenses are those that we cannot prove cash movement out of the business. Examples are depreciation. Depreciation is a loss on an asset, but we never pay anybody cash for that. Number 2 is bad debts. Number 3 is provision for bad debts. 4, what we call impairment. 5, amortization, among others. These are some of the non-cash expenses. We cannot locate them in the cash book or on the bank statement. There's no cash outflow relating to these cash or the type of expenses, so they are called non-cash expenses. The next type of item to define, the next definition that you ought to understand as an accounting student, what we call what? What we call profit. So after we have sales and revenue, we have expenses, we have what you call profit. What is profit? What is profit? Profit, we abbreviate it as PI. PI stands for profit in business. PI is of different forms. You can have what you call gross profit. Number 2, operating profit. Operating profit. Number 3, profit before tax. 4, profit after tax. I will go to this end only for this level. but we shall extend further. These are the main types of profit you expect to encounter, the basic ones. What is gross profit? Gross profit refers to sales minus cost of sales. When you take the sales value, deduct cost of sales, you get what you call gross profit. What about operating profit? Operating profit is sales less cost of sales less operating expenses. Results into what you call operating profit. It is also known as profit before interest and tax, or earning before interest on tax, commonly known as EBIT, earning before interest and tax. Then, what if we deduct interest? What do we get? So when you take sales, less cost of sales, less operating expenses, less finance costs. Finance costs is just interest on loans and debentures. We get what you call profit before tax. And then when we finally deduct tax, we get what we call what? PAT. So that is just profit before tax, we less tax. It gives us profit after tax. So these are the common types of tax profits. So what is profit? From what we've done here, well, let me write it in full. This is sales minus cost of sales minus operating expenses minus finance cost minus tax. What you get is called profit after tax. So what can you see from here? The profits is what remains after deducting these costs. The excess over sales. So we can say pie or profit is the excess of cost of what? Excess of sales over the cost or over expenses. So that is, if I take sales value like 3 million, I deduct all expense as 1.8 million. The excess 1.2. The excess over or the excess of sales over expenses. That the extra value after deducting 1.8 from sales, the balance is what we call profit. So it is the value that remains after deducting all expenses from the sales value. It gives you what you call profit. So next, I want us to look at what we call shareholders. Another important terminology, shareholder. Who is a shareholder? We have got shareholder. Before that, let me talk about stakeholder. Stakeholder. Who is a stakeholder? A stakeholder is somebody that has got some interest in something. When there's something that you are interested in a particular business, we say you have some stake. You've got some interest. So you are holding stake. You are a stakeholder. What about shareholder? So this is somebody holding something. Holding what? Shares. So a shareholder is anybody who has acquired shares from a business. Could have acquired what we call ordinary shares. Those who acquire ordinary shares are called ordinary shareholders or equity holders. Those who hold ordinary shares are said to be what? To be owners or equity holders. Those who hold or who have bought preference shares are called preference shareholders. So get to know that. So a shareholder is basically somebody who has bought shares of a given company. So they're called shareholders. So get to know that. Next, we look at what we call capital. The most misunderstood concept is capital. So many people assume capital to be what? Cash. But cash is just one of the forms of capital. So capital refers to any resource that the owner will use to start up a business or to run his or her business, called capital. So he can pull together different money from different sources and other resources. So it's just what? A pool of resources. Could be physical assets, like you have a motor vehicle, you decide from today, I'll use it for distributing goods to customers in my business. It becomes part of capital. I've got some savings. I've got some things I can sell to put together to run the business. So the resources that are channeled to the business, that are put together to operate a business, form what you call capital. So capital refers to a pool of resources that are used to start up a business. Now we have also another definition that states that capital is the owner's claim against a business. Now, when you talk of owner's claim, we are saying the business belongs to the owner. He's the one who put in the money or the resources in the business. So he can claim what he put in. That's why it's defined as what? Owner's claim against a business. He gave the business the resources. He can claim them back. And we have got different ways of sourcing capital. We have one brought in by the owner from his own sources. That's owner's capital. Or the one through issue of shares. Money brought into the business by the owners is called owner's capital or equity capital if it's from issue of shares. And then we have what you call borrowed capital. Borrowed capital was put in the business by the owner, yes, but from which source? He borrowed or she borrowed from somewhere. It's called borrowed capital. Like loans, debentures, bonds, that is money from other people's hands. You have to repay it back. So it's not our own money that we raise from our own source, we borrowed from somewhere. It's debt capital. And then you have what you call working capital. Now, working capital refers to current assets. These are the part of the assets where most of the activities of the business takes place around on a daily basis. We buy inventory, we sell. So when you open our doors of our business every day, we are open it to sell our trading stock. So we buy, first of all, trading stock from suppliers. We sell it at a profit margin. We collect our debts to those we sold to goods and are yet to pay us. So that's where we have most of the activities. That's the name working capital. So the main operations of the business revolve around current assets. So they form what you call what? Working capital. Now, in business finance or in financial management, we say short-term investments to be financed by short-term financing. Long-term investments to be financed by long-term capital. Now, we talked about assets. We had what we call non-current assets. We had current assets. Another name for non-current assets is long-term investments. These are long-term investments. You acquire them to use for a long period of time to earn your returns. Current assets are for short term. You acquire inventory, you won't be with it for a long time, you'll be selling it very soon. It's called short-term investment. So that's what a short-term investment I'm talking about. So if we cannot borrow a 6-month loan to acquire an asset worth 10 million. That's impractical. We are saying the short-term loan is a short-term financing source. We cannot use it to acquire a long-term investment. So short-term financing refers to current liabilities. So on liabilities, I talked about what? I talked about non-current liabilities and current liabilities. So non-current liabilities are what? Also called long-term financing. Long-term source of finance. And then current liability are what? Short-term financing. Like if you don't have goods to sell and you don't have money to buy the trading stock, you want to finance the buying of inventory, you have no enough cash, you can call your supplier to supply you goods. The act of them supplying you goods is financing your inventory because you don't have cash to buy. So it's a short-term form of what? Of financing. And then, so we are saying, if that is source of financing, it must finance only what? Current assets. So if we finance current assets using current liabilities, we ought to pay back those current liabilities from money we collect from current assets. So if we take current assets and pay the money we got from current liabilities to acquire the current assets, what remains is called, we said first of all, current assets are what? Working capital. So net of current liabilities, we get what we call net working capital. We've net off something from the working capital. The figure that results is called net working capital. Okay, then so those are what? Those are the different types of capital we're going to encounter as we move on. Another term I want you to be familiar with is what we call net assets. What are net assets? Net assets refers to all assets, both non-current plus current assets less current liabilities. So get what we call net assets. We said if you take current assets minus current liability, you get what we call what? Net working capital. So it's also given us non-current assets plus net working capital. That's how we have obtained what? We obtain net assets. Other terms to add on these ones, what you call earn. The term earn, we have got what you call earn, what you call incur. Very important to understand. Most scholars find it hard to differentiate the two, and applying them becomes very hard. Now, to earn is to obtain a right to. Obtain right to receive. Obtain right to receive. When you obtain right to receive something, you've earned. Earn does not mean receiving. So we first earn, then we receive. So like when you serve somebody for a given period of time, let's say for a month, you're supposed to be paid. At the end of the month, on the last day of the month, we say you've earned. The receipt of money might delay, but at that point you've already earned. So earning does not imply receiving the cash. And then incurring is where we do what? We are under obligation. When we are under obligation, being under obligation to settle, okay? Being obliged to settle. Being obliged to settle. When you are under obligation to give out money, when you are under obligation to give out money, you said you've incurred. Like somebody has served you for a given period of time, let's say for a month, and the month has ended, you are supposed to pay them. At that point, you have incurred. In case you have not paid, we shall say it's accrued. Now, after understanding the word earning and incurring, I want us to also understand the word receipt. Receipt and settlement. So once somebody has earned, they're supposed to receive. The act of receiving is called receipt. When somebody incurs, he or she is supposed to settle. The act of paying is what we call what? Settlement. So receipt is the act of receiving. Settlement, act of paying. What if receipt has delayed? The end of the period has come, end of financial year has come, we have not received. We are saying we already obtained the right to receive. And because the time has elapsed and you have not received, it creates what we call what? An asset, a receivable. So you have a term called what? A term called outstanding. Outstanding or accrued. Accrued. So something outstanding is something whose time for receipt or settlement has passed. Who is saying it's outstanding. So we could have what? So outstanding means what? Delayed what? Delayed receipt or payment. Delayed receipt or payment. So an accrued or outstanding income, outstanding or accrued implies delayed receipt or payment. Now, there are two types. We have what you call outstanding or accrued income. What is it? This is income. We said incomes are for earning, expenses are for incurring. So we have an income we have earned, but the receipt has delayed. We have a right to receive. Because we have a right to receive, it's a receivable. What are receivables? They are current assets. That's a current asset. So we shall name the outstanding or the accrual by the name of the income, like accrued dividend income. So you must name the particular income that you've earned, but the end of the year has come without you having received the money. And then you have what you call accrued or outstanding expense. Outstanding or accrued expense. What is it? This is what? This is an expense that at the end of the period has not been settled. You haven't paid for it. We said you have incurred, you are anticipating settlement, the end of the year has come, settlement has not taken place, you haven't paid, so it's outstanding. So because you have incurred, you are liable to pay. So it becomes what? A payable. Payable. What's a payable? It's a current liability. It's a current liability. So those are the many terms you're supposed to understand if you want to have it easy during your accounting study. So next we'll be looking at financial statements, and then we go to what you call uses of accounting information. So next thing is financial statements. Financial statements. There are 5 basic financial statements that are supposed to be prepared by any form of business, namely income statement, also known as profit or loss statement, P&L. Number 2, what we call statement of financial position. Before that, I will talk of statement of changes in equity. Statement of changes in equity. 3, statement of financial position. Financial position. 4, what we call statement of cash flow. Statement of cash flow. Finally, notes to the account. I want to define them quickly. We'll deal with them more in the topics ahead. Income statement is a statement used to report the performance of a company in terms of profit or loss made within a given financial year. Its main elements are, you've got sales stroke revenue, you've got incomes, then you've got cost of sales, or I can call it purchases, and then lastly you've got expenses. So those are the main items or components or elements of income statement we'll be dealing with. Number 2 is what you call statement of changes in equity. We'll look at it mainly in topic number 7, what you call financial statements of a company. For now, equity is just basically owners' capital. That is money contributed by owners through share acquisition. Then we have what we call statement of financial position. This is what we call also the balance sheet. Balance sheet. So balance sheet is a statement that contains three components, what we call assets, capital, and liabilities. So the main elements. So this statement is used to report the financial position of a firm at a given point in time. Then statement of cash flow. This is a statement that will help us to understand where the cash went to, where the cash came from, and why we're having what we're having at the end of the year, and what we had at the beginning of the year. So this statement is used to reconcile opening cash and cash equivalents with the closing cash equivalents in light of inflows and outflows that took place within the year. We shall also cover it in topic number 7 under financial statements of a company. Lastly, notes to the accounts. Notes to the accounts refers to narrations or explanations of what appears on the face of financial statements. So these are just notes that explain what appears on the financial statements I've listed above. So we will talk about them in details as we do different accounts of different businesses. The next thing to handle is what we call the accounting equation. Accounting equation. So an accounting equation is a mathematical relationship between three elements of statement of financial position or balance sheet. What are the three elements? Assets, capital, liabilities. So there's a way they relate. Capital in this context means owner's contribution to the business. Liabilities in this context means the borrowed funds. Assets is what has been acquired using money from these two, from the owner's contribution and the borrowed funds. So you are saying assets equals to capital plus liabilities. So we can use this at any point to ascertain any missing figure among the assets, capital, or liabilities. I have one question I want us to handle together and solve it using the accounting equation. Before that, I would say this side where assets appear is called debit side. We shall deal with it in the topic number 2. This side is called what? The credit side. Also, we shall deal with it in topic number 2, where we shall be doing what we call key accounts or ledgers. So I want us to do a question to illustrate how this can be used. We are saying that when money comes out, it may come through these two channels, either from owners or from borrowed funds, lenders. So this one can be used to acquire assets, or it can remain as an asset in form of cash, as we looked at initially. So let's look at a question, we solve it together, then we see the application of the accounting equation. So I have one question here that I want to handle. Can do many others later. We have this question here of machinery. Machinery is 450,000. You've got land, has nothing. Next you have what you call accounts receivables. Accounts receivables, which is money held by debtors. You have it as 57,000. 57,000. You've got loan. Loan is 850,000. You've got debentures. 750,000. Bank 280,000. Accounts payables 45,000. We have got motor vehicle 500,000. Owner's contribution, called it owner's contribution with a reason. Contribution, the owner has brought in 1.2. And then we have inventory, the trading stock 70,000. You have got prepaid expenses. Prepaid expenses as 20,000. Lastly, accrued insurance 15,000. Accrued insurance. Have it as 15,000. So before we can adopt the accounting equation, we must first classify them as either being assets, capital, or liabilities. Machinery, we had said it falls under what? Assets. Land is asset. Accounts receivables are current assets. Loan is what we owe, liability. Debentures is what we've gotten money from other people through, so it's a liability. Bank is money we have at our bank account. It belongs to us, an asset. Accounts payables, what you're supposed to pay, liability. We've got motor vehicles, what we own, an asset. Owner's contribution, what we call capital. Inventory is what we bought using our cash, we call it an asset. Then prepaid expense are expenses for next year, paid for in this year. That is still our money we ought not to have paid. It's an asset. Then accrued insurance. Insurance is an expense. It's outstanding. We have not paid it. An expense that's outstanding is what? A liability. It's a kind of liability. So it's just a liability. So having known that, we can use our accounting equation. Assets equals to capital plus liabilities. So what are assets? The sum of assets. I'll add all assets, then input where assets fall. So one of them is a known. I will make it what? X. I'll call that X. So we have 450 plus 57 plus 280 and plus 500 plus 70 plus 20. So assets is 1377. Assets value is 1377,000 plus X for land equals to, we go to capital is 1.2 million. Let's look at liabilities. The first one is 850,000 plus 750,000 plus 45,000 plus 15,000. That is 1660. So 1660,000 is the value of liabilities. 1660, the value of liabilities. So you want to get the value of X. So you're saying that is 1377,000 plus X equals to 18. No, that is 28. 28. 60,000. 60,000. So what is the value of X? X will be 28. 60,000 minus 1377. Minus 1377,000. So the value of X, which is land, is 1483,000. That is the value of land. And that's how we can use the accounting equation to get any unknown. Value among elements of the statement of financial position. The last part of this topic, what you call users of financial statement. The last part is users of financial statements. Users of financial statements. Now, these users are also called stakeholders of financial information. They are called stakeholders or interest groups. So you may be asked users or interest groups or stakeholders, they mean the same. We've got different two types of users of accounts. We've got those that are within the company are called internal users. And then we have what we call external users. Internal users are the owners, the directors, the managers, and the employees. They are internal users. External ones are those people who are not found within, but they also have interest in the accounts of the firm. We talked about the financial statements. The financial statements are part of the financial report. The information we're talking about here is in the financial report. Part of the financial report is the financial statements and the note to the accounts. They form the financial information. So people have got different interests. Every person involved in the business or who interact with the business have got their area of interest. The rest doesn't bother them. Who are the internal users? The internal users are, one, the management, and number two, the employees. These are the main ones. Now, we're going to look at the user and their interest in the business. What's their stake? What is their point of concern in the business? Management refers to the team of individuals manned with the responsibility of running the business. They do so through decision making. So we are saying the management main concern is, are we able to run this business efficiently and effectively using through what? Decision making. So their main need or their main interest is the ability to run the business effectively and efficiently through decision making. So they will be looking at the performance and gauging what they decided upon vis-a-vis the performance. Is it yielding something, or are we going to be fired very soon because our decisions have landed the company into trouble or into losses? Employees. Employees refers to a team of people who provide the workforce to the company in exchange of what we call salaries. Now, what is their main interest when they're coming to work for this company? And in this context, I'm talking of both current employees and prospective employees. If you are going to be employed in a company somewhere, you become a prospective employee. That is, let's say you're going to do an interview somewhere and you've got interest in knowing this company. Your main points of concern are very few. You must know for the history of the company, what it deals with, but your main interest as an employee would be one, the pay. Are they able to give me competitive? We don't call it high or a lot or expensive. We call it what? Competitive. That is fair or competitive. That is what somebody of my qualification would receive and feel satisfied and feel well remunerated without feeling that somebody has taken advantage of you. It's called fair or competitive remuneration. So that's one of their interests. Ability of the firm to fairly remunerate them. So after that, yes, I'm going to accept the employment. How am I going to deal with this company? How long are we going to be relating with this company? Are they going to chase me out anytime they feel like chasing me out? That's another issue of concern. So employees are also concerned about what we call security of tenure. Security of tenure, or just what we call what? Job security. Am I safeguarded or by some are there some protections on me, or I can just be thrown out anytime because security of tenure, they are concerned about that. Something else is the ability of the firm to pay them post-employment benefit upon exiting or upon retirement. Have I something to carry home? Does the company have a post-employment plan for employees? So when you're looking at the statements, you'll go and look at if they have got a post-employment plan for the employees. And if there's one, then you feel you're safe. Then next, we have what you call what? You're talking of promotions. If there are promotions, fair promotions to employees. This is another issue of concern. If the company is promoting people based on meritocracy, career advancement, also another area of interest. I'll talk of one more in terms of what you call security or safety. What you call working condition, the best word to use, working conditions. Is the company able to provide conducive work environment or not? So that's another area of interest to an employee. So those are the main needs of an employee as one of the internal what? User of account. Now on the external ones, external users, we have the following. Number one, customers. Number two, suppliers. Number three, the government. Number four, we've got we have government and what? Government agencies. We've got general public. So it's another group. 5, you've got competitors. So let me discuss those first, then we add on the list other users, but the main ones. Number one, customers. Who are customers? Customers are the consumers of the trading stock, or the consumers of the services of the company. What's their interest when they look at the financial report of the company? Their interest is, one, the ability of the firm to offer them what? Quality goods at affordable prices. Quality goods at affordable prices. Affordable does not affordable doesn't mean cheap. Oh, don't use the word cheap or low. Affordable doesn't mean that the amount is not much. The value of the shilling could be so much, but does it match to the value of the product? So affordable price is a price that matches the value. 1 million could be affordable if the commodity is worth the 1 million. So talking of affordable doesn't mean what? Doesn't mean cheap. So that's the first need. Number 2, what we call safety products. Ability of the firm to offer them what? Safety products. That's why if you look at most products packaged in cartons or on top of the packaging of the product, there are some instructions on how to use the product, how to store the product. You see some of them, you're being told that store in a cold and dry place. They tell you how much to stack. That is the height of the number of items to stack upwards, and then how to dispose the packaging after use. Those are what? Safety measures on how to use the product by the consumer. So every consumer is concerned of the safety. Expiry dates must be fixed there. Mark of quality, that's why you see most products, the KEBS mark of quality. ISO certification, we find most of the products packaging, we have those instructions the safety and the disposal or even of the packaging after use, how long you can use, how to store the product, so that in case you complain or you sue a supplier of some goods that they have given you expired goods, you'll be called upon to provide maybe the batch numbers so that similar product can be checked to confirm, yes, your product was not safe for use or it was safe for use. So the supplier must always provide you as the customer with those instructions or guidelines. So a customer will be concerned about such kind of matters in terms of the commodity or the product they are acquiring. So quality very important, safety very important. Another thing is weights and measures. That's why most or I say all products must come with weights attached, the tonnage attached to the product, so that if the person who sold you sells you a product of 50 kgs and yet it's only 45, you have the power or you have the right to sue them for having given you products whose quantity is less than the one marked on the product itself. So among many others, those are some of the needs of the customers when they come for the goods from the company. Number 2, suppliers. Suppliers, we say, they are providers of the trading stock. Their main concern is, are you able to pay me on time? How will they prove? When they look at the financial statements and they see that you're owing so much to other suppliers in the past years in terms of current, that is accounts payables, then they might fail to supply to you on credit. If they're going to give you credit, it must be short-term credit. So they may end up selling to you on what? On cash, because they have seen evidence you don't pay on time or you have too much owings that if they supply you, you are likely not to pay them. You might default. They're also looking at their ability to work with you long-term by looking at your going concern. Are you a going concern? Are we going to supply and then the next day you're going to close? They'll have to check at the going concern assumption. That is your ability to continue in operation in the foreseeable future. So they have to assess you and see, yes, we are safe by supplying you with the product. Then we have what you call lenders. Number 3, I will talk about lenders. Who are lenders? These are providers of long-term credit. These are the loan providers, among others. So that could be circles, could be banks, those who lend you. So for them, they'll have to look at the statement and look at your ability to pay. How will they know you are paying? They will look at your cash flow statement and see how much you paid in terms of interest on debentures, interest on loans you've been given before. So if they see you have been paying, then they can have the trust that you're paying. Okay, they'll look at if there have been any litigation against you for non-payment of loan interest and debenture interest again, then they will refrain from, they will not give you credit. And if they will give you credit, it will be at a very high cost, so that they could discourage you from borrowing from them. Next, number 4, we have what you call competitors. Competitors, who are these? These are rivals in business. These are your rivals in business. And their main concern is, 1, how much you control in terms of market share. How much are you controlling of the clients we are all serving as people in this industry? How much are you controlling? Your competitor will always want to have more than you. They want to control more than you. So that's one of their main interests. They look at your customer base. When they look at your financial statements, they look at the growth in your customers, and they'll be trying to counter to get more on the clients. Number 2, they look at what you are best at that makes you have more clients, what you call competitive advantage. They are more concerned about what you are good at or what gives you a competitive edge in the market. Number 5, we could talk about government and government agencies. The government and government agencies, the top of the government is the authority or the top of the authority under which you operate your business. That is the jurisdiction within which your business is set up. It's called the government. So government has main interest being your ability to run legal business. The government has some businesses that cannot allow somebody to operate, like child trafficking or human trafficking is not allowed, it's illegal. Let's say even if you're going to have a stripping business, that is immoral to the society. It may not be allowed. You can't be allowed to register such kind of a business in Kenya or any other country. Then two is compliance. Are you able to comply with tax regulations? Are you able to comply with the regulations in the industry where you're operating? That's the other interest of government. Number three, are you able to pay taxes on the profit you're making in the year? So those are the main interests in our business from the government side. The other user is what we call the general public. General public, I will talk about the public as the local community within which a business is set up. And every business being opened, the community always asks themselves, what do we have to benefit from this business? They want you see you employing part of the local community. They want to see you buying raw materials from the local community. So they want to see your involvement in the community affairs, what you call CSR activities. Are you going to be involved in any community affairs? Like when you have issues like health promotion, we could have something like people raising funds for those with heart problems, cancer problems, HIV issues. We are raising funds to support those kind of people in the society, the needy or less fortunate. That's why most companies will want to have programs that are meant to alleviate suffering from the society. They want to be involved. And by so doing, they gain public acceptance or community acceptance to operate in that community. So those are the many users. Maybe I'll talk of one more. What you call shareholders. The last one, talk about shareholders. So we talked of the government. We talked about the local community. Then you're talking about shareholders. Who are shareholders? I'm talking about both current shareholders and prospective shareholders. Shareholders' need is one, is this company going to make profit or are they making profit? Can I buy more shares or can I buy new shares? Number two, are they able to pay dividends? There are some companies that are making profit, yes, but they declare zero dividends or they don't pay any dividends. You have an example of Tesla company. Tesla has zero dividend payment policy, doesn't pay. So that's the end of our topic number one. We'll be covering topic two later, and we'll learn more about what you call accounting system and processes. So that's all for today. Until next time.
If you enjoyed this video, please like, subscribe, comment, and don't forget to hit the notification bell so you never miss an update.